Hey traders, Jason here from Levitt Brothers. So in this video, I'm going to talk about some positive divergences that are giving a little bit of hope to the bulls. Obviously, the market's in pretty bad shape. A couple weeks ago, it had a big update, immediately gave back the gains. Last 2 weeks ago, it had two huge updates to start the month of October. Those gains were given back, and then this past Thursday, the market gapped down, posted a huge update, and those gains have been given back too. So for several weeks in a row, the market has tried to bounce. It just can't put together a winning streak beyond just a day or two. But there are some positive signs beneath the surface, and I'm tempted to say that if the market was functioning normally, it will bounce. Okay, what I mean by functioning normally is like even in a downtrend, even if the market's pretty weak, when you get oversold indicators, when you get positive divergences, when things get stretched to the downside, you should be able to get a bounce. You know, 5%, 10%, even if you only get a couple percent, the market should be able to bounce from an extremely oversold position. If it can't, look out below. But I'm here to tell you that there's actually some positive signs beneath the surface. So the stage is set for a rally attempt if the bulls want to attempt it. But if they can't, I'm kind of scared of what could happen here. All right, so I'm going to go through some divergences, kind of show you what I see is going on beneath the surface. All right, so here what we have is the S&P 500 up top, and in the next two charts are the 10-day moving average and the 20-day moving average of the NYSE AD line. Okay, so the idea here is positive divergences tell you that even though the market's weak, that it's less bad than it had been previously. So for example, over here at the beginning of the year, January and February, the market bottomed in January, bounced up, and then bottomed again in February. And the 10-day moving average of the NYSE AD line and the 20-day of the AD line put in a positive divergence. That means however bad things were here, they were less bad over here. Okay, so they weren't great, but they were less bad, and that tells you that the bulls are the bears are starting to lose their grip. And in this case, you can see the market bounced up, flattened out for a few more days, and then it eventually rallied after that. Okay, so you see if you put if you glide across the chart, you'll see these occasionally form, and each time they form, you tend to get a little bit of a bounce. Here was one in May. Where we got a double bottom. The second bottom was lower, but we put in positive divergences between the 10 and the 20 moving averages. So bring our eyes over to the current position. We have a very obvious lower low. So we had many positive divergences at the end of September, as you can see. There was a lower low right there. That led to the big 2-day bounce that started October. Now we have a bigger divergence that's forming between those lows in late September and the low of last week, and you can see with the 10-day we have a very obvious divergence. With the 20-day, it's less of an obvious divergence, but it still counts. It's still there because we didn't make a lower low. So it tells you that the market, beneath the surface isn't necessarily in great shape, but it's in less bad shape than it was, and it should be able to fuel a bounce here. All right, next chart. Here's the breadth thrust indicator, and what that is it's the NYSE advancing volume versus total volume, and it's the 10-day EMA of that. So as you move your eyes across this, and you can pause the video and you want, and you can see this, is that there are many divergences all over the place, both in the positive and negative direction, and in all cases they lead to reversals. Sometimes those reversals last a few days, sometimes a week, sometimes much longer. So as an example, back in January, February, let me change the color here just so you can see where I'm drawing. So we had this lower lows here, but the breadth thrust put in a higher low here. So over here, this print isn't necessarily very good, but it's less bad than here. So it tells you that little by little the bears are starting to lose some of their feistiness. We got lower low here, higher low there, market bounced, etc., etc. I'm not going to go through all of them. You can pause the video if you want to see them. But fast forwarding over to today, we have market making lower lows here. We had a mini one right over here, which led to the bounce in, or I should say led to the big move in early October. But now we have a bigger one forming right here. Okay, so the market makes a low here, and we get the breadth thrust down here, and then the market makes a lower low over here, and we get a higher print here. So positive divergence tells you things are less bad. Bulls are starting to assert themselves a little bit. In this, if the market is functioning normally, we should be able to get a bounce from this situation. All right, next up, this is SP5, or this is the NASDAQ up top. Green is the new NASDAQ new highs, red is the new lows, and then the black line below is the high-low indicator. So divergences, what we're looking for in a downtrend, we're looking for divergences between the index and the new lows. Okay, new lows will tell us, new highs don't matter because in a downtrend you just don't get that many. You won't get any signals. So we're looking for the situation getting less bad. So you see here in February and March, you have the market makes a lower low, but the number of stocks printing a new low declines. Okay, so market prints a low over here in February, and you get this many new lows, and then the market prints a lower level a couple weeks later, but now only this many stocks are printing a new low. Okay, so some stocks are starting to hold up. Okay, so that positive divergence tends to lead to a nice bounce. As you can see what happened in March there. Moving our eyes across this, we had a lower lows there, and then less stocks fell to new lows, so that's positive divergence. And then the high-low indicator, of course, put in a higher low. So we fast forward to today, market's trending down, lower highs, lower lows, but on this most recent dip to a new low, we have less stocks falling to, less stocks are printing new 52-week lows. So however many stocks over here, we had 1,200 stocks printing new lows, and last week we had less than 1,000. So there was more than 200 stocks that were able to hold their lows. Okay, so a little bit beneath the surface, the situation is less bad. If the market is functioning normally, we should be able to get a bounce from this area. Next up is SP 500 up top. Down below is the 5-day total of new highs minus new lows. Okay, divergences work the same way here. I don't need to go through them. So over here, back in Q3 of 2021, you can see lower highs there, or lower lows, I should say, but we're getting a better reading here. So that induced like a rally that went into the end of the year. And if I fast forward to today, so over here we have lower lows from the market. We have higher low from here. And what happened? The market bounced. And then zooming in closer to today, we have lower low there between the June low and the recent low in September and in October here. We have higher low here. Okay, so whatever the situation was over here, it's less bad. And then just even last week, hard to see in this chart, but we printed a new low on Thursday, but this print was up here. Okay, so we got positive divergences here that tell us that the situation isn't great, but it's less bad than it's been. Okay, for the market to actually move up, we're going to need, you can see here that these prints have almost entirely been below zero. So how will I know the market's like actually going to trend up and like hold an uptrend? Well, this indicator will get above zero, just like you can see it on the left side of the chart. As long as it stays below zero, bear market's in place. But even within a bear market, positive divergences will should lead to bounces if the market is functioning normally. Which is debatable right now. Okay, last one, this S&P 500 up top, and down below is the S&P 500 stocks above their 20-day moving average right here, and above their 50-day moving average here. Okay, divergences work the same way when you get like lower lows, lower lows, lower lows, but less stocks are falling at lower lows, less stocks at lower lows, not at lower lows, less stocks are below, less stocks are below their 20-day moving average. So more stocks are above their 20s, more stocks are above their 20s. Down below, more stocks are holding above their 50s, more stocks above their 50s. So looking over to today, market has fallen to a lower low, but these indicators are both putting in a positive divergence. Okay, so when the market made a new low here at the end of September, you had nearly zero stocks above their 20-day moving average, and you had maybe looks like about 3 or 4% of stocks above their 50. And then last week, as of the close on Friday, we have 20% of stocks are above their 20s, 20-day moving averages, and about 15-16% of stocks are above their 50s. So situation isn't great, but it's less bad than it's been. This should lead to a bounce. Okay, so market's in bad shape. It's going to go much lower. I've been saying that for months. I mean, way back in the early summer, I was saying my market's going to drop to like 3,000. I'm still on board with that. We're going down to 3,000. But even if the market's going to go that far down, there can be bounces along the way. If the market wanted to bounce now is the time, because there are positive divergences forming all over the place. So a bounce isn't just like a hope. There's actually some technical support for such a bounce to take place. And with the next FOMC meeting being 3 weeks away, and earnings season really doesn't get into full gear until the end of this month, beginning of November, we have a period here where there's not that much news-wise that could shock the market. So the stage is set for a rally. Not a rally. Well, the stage is set for some upside movement if indeed the market wanted to give it a try. All right, hope you got something out of this. I'll see you next time.